Imagine you have 1 lakh rupees or maybe $1,000 sitting in your savings account. The bank is giving you maybe 3% interest per year. Now imagine walking into that same bank and saying, I won't touch this money for 1 year. Suddenly, the bank offers you 6.5, sometimes even 7%. Same bank, same money, more than double the return, just because you made a commitment. That's a fixed deposit. Simple on the surface, but once you go deeper, there are choices, strategies, and traps that make most people never think about. By the end of this video, you'll know exactly how FDs work, what the fine print hides, and how to use them smartly. Hey guys, I'm Adam and welcome to Big Brain Buddy. Quick question before we start. Does financial jargon make your head spin? SIP, XIRR, TDS, CAGR. If you've ever stared at one of these words and quietly thought, what does that even mean? This series is for you. The series is called Small Steps, Big Wealth. We take one financial product at a time, strip the jargon out, and explain it like a real person should have explained it to you years ago. Today, fixed deposits. Let's get into it. A fixed deposit or FD is a product offered by banks and NBFCs, non-banking financial companies. You give them a lump sum of money for a fixed period of time called the tenure, and in return, they promise to pay you a fixed rate of interest, no matter what happens in the economy or the markets. Three things are logged in from day one: the principal, the rate of interest, and the tenure, which can be anywhere from 7 days to 10 years. At the end of the tenure, called the maturity date, you get back your principal plus all the interest earned. No surprises, no stock market dependency. That's the core promise. Think of it like this: you're lending money to a bank, and the bank is paying you rent for using it. The longer you lend, the more rent you earn. Now, let's talk about how interest actually gets calculated, because this is where most people gloss over and lose money silently. There are two methods the bank use. Simple interest: the deposit calculates interest only on your original principal every single time. So if you deposit 1 lakh at 7% for 2 years, you earn 7,000 per year, totaling 14,000 at the end. Straightforward. Compound interest: this is the more powerful one. Here, the interest you earn in one period gets added to your principal, and the next period's interest is calculated on that larger amount. You're essentially earning interest on your interest, and the frequency of compounding matters. Quarterly compounding, which most bank FDs use, gives you more than annual compounding, even at the same stated rate. Here's a real example: 1 lakh rupees, 7%, 2 years. With simple interest, we just saw it was 1 lakh 14,000. With quarterly compounding, it comes up to be 1,14,888. That's nearly 900 extra. And this gap widens dramatically over longer tenures. Not all FDs are the same. There are several types, each built for a different situation. Regular FD, the standard one. You pick a tenure, get a rate, and can break it early if needed, though with a small penalty. Tax saving FD, 5 years mandatory lock-in. You can't withdraw early, no exceptions. But up to 1.5 lakh qualifies for a deduction under Section 80C. There's a catch though. The interest earned is still fully taxable. Tax saved on the way in, not the way out. Then there are senior citizens FDs. The bank offers an extra 0.25 to 0.75% to depositors above 60. Over a large corpus, this adds up. Then there are flexi or sweep FD, linked to your savings account. If your balance runs short, the FD auto breaks in parts to cover it. FD returns with the savings account flexibility. Then there are corporate or NBFC FD, higher rates, sometimes 1 to 2% above banks. It comes with a higher risk too, no deposit insurance coverage. Then there are NRE and NRO FDs for non-resident Indians. The NRE FD is particularly attractive. Interest earned is completely tax-free in India. When you book an FD, one of the first choices you make is, when do you want your interest, monthly or quarterly payout? The interest gets credited to your bank account regularly. Ideal for retirees, for anyone needing a steady income stream. The effective yield is slightly lower because the money isn't compounding, it's being paid out. Cumulative or reinvestment. Interest isn't paid out. It compounds over the full tenure. One big payout at maturity. Better if you're saving towards a goal and don't need the cash in between. There's a simple rule of thumb. If you need regular income, go periodic. If you're saving for a future goal, go cumulative. What happens if you need the money before the FD matures? Most banks allow premature withdrawal, but they penalize you for it. Typically, they reduce your interest rate by 0.5% to 1% compared to what you were promised. So if your FD was at 7%, you might actually receive only 6%. But here's the smarter option most people don't know about: a loan against FD. Banks will lend you up to 90% of your FD value at an interest rate that's just 1 to 2% above your FD rate. If your FD earns 7%, your loan costs you 8 to 9%. Compare that with a personal loan at 12 to 18%. Your FD keeps earning, your loan funds your need. Win win, as long as you repay. Let's talk about something most people discover too late. FD interest is fully taxable. Every rupee of interest earned is added to your total income and taxed at your applicable slab. In the 30% bracket, nearly a third of your FD interest goes to the government. There's also TDS, tax deducted at source. If your FD interest crosses 40,000 in a year or 50,000 for senior citizens, the bank auto deducts 10% TDS before crediting it. No PAN, that rate jumps to 20%. But if your income is below the taxable limit, you can submit a Form 15G or 15H for senior citizens at the start of the financial year. The bank stops deducting TDS. Just remember, TDS is not your final tax. You still need to declare the full interest in your ITR. Here's a safety net most Indians don't know exists. Every bank deposit in India, including FDs, is insured by DICGC, the Deposit Insurance and Credit Guarantee Corporation, a subsidiary of the RBI. If a bank collapses, you are covered up to 5 lakh rupee per depositor per bank. That includes your savings account, current account, and FDs all combined. So if you have, let's say, 8 lakh rupees in FDs at one bank, only 5 lakh rupees is protected. The smart move here can be, if your FD corpus is large, spread it across multiple banks. So each stays within the 5 lakh cover. Although, note that this insurance only applies to bank FDs. NBFC FDs are not covered. Cool, this is the part where basic FD users become smart FD investors. The problem with one long-term FD, you lose liquidity, and if the rates rise after you have logged in, you're stuck. The solution is FD laddering. Instead of putting 5 lakh rupee into one 5-year FD, split it. 1 lakh in 1 year FD, 1 lakh in a 2-year FD, 1 lakh in a 3-year FD, 1 in 4, and 1 in a 5-year FD. Every year, one FD matures. You get access to the funds regularly, and when each one matures, reinvest it into a fresh 5-year FD, potentially at better rates. Over time, one 5-year FD matures every single year. High returns and regular liquidity. One of the most underrated personal finance strategies out there. So, to recap, a fixed deposit is not just a place to park money. Used well, it's a tool for predictable returns, tax planning, liquidity management, and capital protection. Key things to remember though: first, check if the interest is simple or compound and the compounding frequency. Then, choose the right type: regular, tax saving, senior citizen, or flexi. Then, understand TDS. File a Form 15G or 15H if applicable. Then, use loan against FD instead of breaking it prematurely. Keep your individual bank FDs within the 5 lakh rupees for full DICGC coverage. And use laddering to balance returns with liquidity. In the next episode, we will take a look at bonds, how they're similar to FDs, how they're very different, and why a bond's price moves in the opposite direction to the interest rates. That one surprises a lot of people. See you there.